There's an old proverb intelligence agencies live by. The loudest battles are distractions. The real war is fought in silence. That single sentence explains everything you're seeing in silver right now. Because while headlines were screaming about tech stocks, AI bubbles, rate cuts, and crypto volatility, silver was doing something far more dangerous. It was rising without permission. No hype, no mania, no retail stampede. Just steady, relentless pressure upward until suddenly the impossible happened. Silver printed a fresh all-time high. And the most unsettling part isn't the price. It's how we got there. This is not what a speculative blow-off looks like. This is what accumulation looks like when the buyer does not want to be seen. You could feel it weeks ago if you were watching closely. Pullbacks stopped behaving like pullbacks. Dips became shallow, mechanical pauses, as if the market hit a... If you've been following this investigation from the beginning, you know the first rule of real market moves. Price always moves before narrative. And silver's narrative is still asleep. Most investors still think of silver as the poor cousin of gold, the volatile sidekick that never quite lives up to the hype. That belief is exactly why this move is so dangerous. Because markets punish consensus right before they rewrite it. Look at the tape during the weeks leading up to the breakout. Large sell orders hit the market and vanished. Not absorbed slowly, not chipped away. Gone. Like stones dropped into a black hole. That tells us one thing. There's a buyer underneath this market who does not care about short-term price. Someone who is not trading silver, someone who is acquiring it, and when acquisition replaces speculation, price discovery changes forever. Here's the forensic clue most people missed. Open interest in paper silver rose, but physical availability tightened at the same time. That shouldn't happen. In a healthy market, paper and physical move together. When they diverge, it means someone is pulling metal out of circulation, while others are still trading promises. That's the moment when leverage becomes a weapon pointed at the system itself. The most common question I get at this stage is simple. Isn't silver always volatile? Isn't this just another spike? And under normal circumstances, that would be a fair question. But this isn't a spike. Spikes collapse quickly. This move climbed like a staircase, step by step, leaving no air pockets underneath. Every time the market tried to shake weak hands out, it failed. That's not retail behavior. Retail chases, retail panics, retail overreacts. This market did none of that. Something was loading beneath the surface, like a spring being compressed 1 millimeter at a time. And springs don't stay compressed forever. But that only answers the first mystery. That's where part 2 begins. Part 2, the buyer you were never supposed to see. If you just watched part 1, here's the key takeaway. Silver didn't rally because people suddenly love silver. It rallied because someone needed it. And when need replaces desire, price becomes irrelevant. Let's start with what silver actually is, stripped of nostalgia and coin shop mythology. Silver is not just money, it's infrastructure. It's electricity in solid form. It's the metal that makes modern life function quietly in the background. Solar panels, EVs, data centers, medical equipment, military electronics, AI hardware, high-frequency trading servers. Every one of these systems consumes silver, not as an investment, but as a consumable input. Once used, much of it is gone forever. Now overlay that reality with the macro backdrop nobody wants to connect. Governments around the world are simultaneously pushing green energy mandates, electrification targets, AI expansion, and defense spending. Each one of those trends alone increases silver demand. Together, they create something far more dangerous, structural scarcity. The quiet buyer in silver is not a hedge fund chasing momentum. Hedge funds don't drain supply chains. The fingerprints point somewhere else. Industrial off-takers, sovereign procurement channels, strategic stockpilers who don't publish press releases when they move. These entities don't care about RSI. They care about continuity of supply. They don't buy dips. They buy everything available at whatever price clears the market. Because the cost of not having silver is far higher than paying up for it. And here's the twist most people miss. Silver supply is not elastic. You cannot simply turn on a silver mine. Most silver is produced as a byproduct of copper, lead, and zinc mining. That means even if silver prices double, supply does not immediately respond. It's locked behind decisions made years ago. That delay is deadly when demand accelerates suddenly. This is where the macro crisis sneaks in through the side door. Inflation didn't go away. It just changed masks. Central banks printed trillions, and now governments are competing to secure real assets before currencies lose further purchasing power. Gold gets the headlines, silver gets the contracts. Skeptics will say, if this were true, we'd see it in the data. But that's the point. Strategic accumulation avoids visible data. It moves through opaque channels, long-term contracts, and off-exchange settlements. By the time it shows up publicly, price has already adjusted violently. Think of it like a military supply line. You don't announce stockpiling ammunition after the war starts. You do it quietly beforehand. Silver's rally is not a trade. It's a signal. And if you think this only affects silver investors, you're missing the bigger picture. Because when one critical input tightens, it doesn't just go up. It crowds everything else out. That's what part 3 is about. Part 3, the collateral damage. Nobody is pricing in. If you've been following this investigation, you already know markets are zero-sum systems at turning points. When capital flows aggressively into one asset, something else pays the price. Silver's breakout is not happening in isolation. It's happening while manufacturers are already under margin pressure, while supply chains are fragile, and while governments are promising more production than the physical world can deliver. That creates collateral damage. First, industrial users lose optionality. When silver prices rise rapidly, they can't hedge effectively. Contracts get repriced. Delivery schedules slip. Costs rise. Those costs don't disappear. They move downstream into consumer prices, defense budgets, energy projects, and infrastructure timelines. Second, paper markets come under stress. Futures and ETFs rely on confidence that metal can be sourced when needed. When physical tightness collides with leveraged exposure, you get forced behavior. Rolling contracts becomes expensive. Liquidity thins. Volatility spikes not because people are excited, but because exits get narrow. Third, retail investors get emotionally whipsawed. Many will chase late, buy breakouts emotionally, then panic on the first sharp pullback. That's how wealth transfers happen during structural bull markets. The asset doesn't fail, the holder does. This is why the most dangerous phase of a bull market isn't the beginning. It's the middle, when disbelief turns into frustration. When people say, "I missed it," right before it accelerates again. And that acceleration is already being set up technically. Which brings us to the final phase. Part 4, the vacuum above and the psychology of holding. If you just watched part 3, here's where everything converges. Silver didn't just make a new high, it broke into open air. Above this level, there's no historical resistance, no memory, no trapped supply waiting to sell. That creates a vacuum. In vacuums, price doesn't climb, it jumps. Technical targets become less important than behavior. Stops cluster, shorts retreat. Momentum systems flip from neutral to forced buying. Algorithms don't debate fundamentals, they execute rules. And rules say one thing when records are broken: buy strength. This is the phase where markets feel irrational to anyone not positioned. Pullbacks feel shallow and unfair. News becomes irrelevant. Every dip gets bought faster than the last. That's not euphoria yet. That's disbelief fighting inevitability. The psychological challenge now is not finding silver, it's holding it. Humans are wired to fear giving back gains. The instinct to lock it in is powerful, but history is clear. The biggest moves happen after records are broken, not before. Silver's rally is not a headline event. It's a regime change, a recognition, slowly and then suddenly, that something essential is scarce in a world that needs more of everything. This move will be remembered not because silver went higher, but because of when it did. At a time of technological acceleration, geopolitical stress, currency dilution, and energy transformation, silver is not reacting, it's repricing. And that's why this isn't the end of the story. It's the beginning of a chapter that most people won't believe until it's too late. History doesn't reward attention, it rewards positioning. If you want to understand these moves before they hit the headlines, if you want to stay ahead of the crowd instead of chasing it, make sure you're subscribed. Because the quiet wars are the ones that change everything.